webinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast.
I'll be presenting today's webinar presentation for you. We've got lots of people on today, and so again, thank you for taking some time out of your Saturday to be with us. We're real excited about today's webinar. We're going to be talking about cashing in on foreclosures. We're going to cover lots of ground, but before I get into the agenda for today, I just want to make sure that everybody knows how to use this system that we're on. It's a pretty simple system. I'm going to go through the presentation. It should take about 45-50 minutes for me to get through the presentation today. And if you have any questions for me, I'm going to ask you to type the question in on the towards the bottom of your icon box on the right-hand side of your screen. You should see a section that's called questions. Well, if you just put your cursor in there and you cover it, you're going to be able to type me a question. So right at the end of the presentation, I'll do some questions and answers of any questions that come in. And just in the sake of time, if there is too many questions and I can't get through the questions in the time that we have, I will make sure that our client care department gets back to you and answers the questions that you have. And if you want to type me a question right now, or if you want to type me a hello, Travis, just to make sure that it works, feel free to do that. Just to test it for yourself, just to make sure it works. And if you want to do that, that'd be no problem at all. Again, thanks everybody for joining us. What we're going to cover today is we're going to cover lots of ground today. We're going to talk about, first of all, just a brief intro as to who is Arizona Investar and what is it exactly that we do. Right now, one of our chosen markets that shows strong fundamentals and technicals for real estate investors in all of North America is Phoenix, Arizona. So we're going to talk about why Arizona, and then we'll talk about the opportunity that has been created primarily due to the subprime meltdown, and you know, somebody else's disaster is somebody else's reward. So it's an opportunity for us to really participate in the undervalued real estate market. So we'll talk about the opportunity, and in order to give you a good education, I'm going to go into some market overview as to what's happening in that marketplace, so you have a good understanding of what's happening in the Phoenix real estate market and why is it good for Canadian investors today. We're going to talk about a little bit about how you're able to acquire investment properties before they're made available to the public. It's always nice to have that benefit to be able to buy properties before they're made available to the public. I'm going to show you how we make that happen for you, and we'll talk about our complete system and how that works for you. We're going to get a little bit into property management and talk about that and how that works. And we'll go through the numbers, how the numbers actually work on some of these properties. We'll get into some foreign national financing or a U.S. bank financing. A lot of Canadian investors, they use their Canadian banks. They pull home equity lines of credit on their houses and use cash. And some of our investors are also using some of our U.S. bank contacts, which allows them to maybe assist buy that first home, but maybe helps them buy a number of houses. And so we'll also talk about maybe some current opportunities that are available, and then we'll wrap it up by getting into some questions and answers that you might have through the course of this webinar. But again, thank you for taking time out of your Saturday to be with us, and I hope you enjoy the program. First of all, who is Arizona Investar? Well, we like to classify ourselves as your true turnkey real estate investment team. And what a turnkey investment means is it means that we walk you through the entire process. You know, a lot of investors, they like the thought of investing in real estate, and a lot of investors have been made money on their own principal home, and that's one house. What if you could have 2, 3, 4, 5, 10 of your own homes? Wouldn't that be a great thing? Because you've understood the power of real estate and how it can work for you and really assist you with increasing your net worth and your retirement funds. We're going to get into the market research analysis with our team. We'll talk a little bit about how we provide that for you and how we educate you on the market. We'll get into the property selection process. We also have a full renovation contractor that works with us and works with all of our investors for their homes, not only for the rehab of the houses, but also any small repairs and maintenance needs to be done through the way. Cross-border taxation specialist, that's part of our turnkey system as well, where we provide a full cross-border tax consultation to you before you buy the house, and that's the key thing, is before you buy the house. And we see a lot of Canadians making mistakes today where they're going down to the U.S. They think it's a good opportunity and they're buying blind. Most of them, I think, are probably making a mistake by their strategy they're deploying. Canada-U.S. mortgage lenders are part of our turnkey system. Property management, that's all part of our system. Insurance, foreign currency exchange, and then, of course, having some great investor reporting after you've bought your house, keep you up to speed with the market analysis and what's happening. Arizona Investar's executives have been in the real estate industry for just over 28 years, and we're comprised of an entire team, both in Canada and the U.S., that make these real estate investment opportunities happen for our Canadian investors. We have a physical office location in Calgary and Phoenix, Arizona. Our core business, what we do, our core business is providing turnkey real estate investments. Currently right now in the Phoenix market, we deploy just over $25 million of Canadian investor capital to the asset class, so we're well entrenched, and we've deployed lots of funds, bought lots of houses, and we think we've got a true proven system here that works for our investors. And I guess you could say the kinks are out of the system. And when we did that actually to start with our own capital, our own corporate capital, when we tested that market and got the bugs out of the system. And so now we've got what we feel is a well-oiled machine to provide to our Canadian investors. Our property management company has just over 1,500 homes under management, and our current vacancy rate on our portfolio is 2.75%. So it's a really good vacancy rate. It's a low vacancy rate, so it really shows the strength of that rental market. Real estate investments can provide a number of things to our Canadian investors, but first and foremost, it's it can provide additional income. So that's additional monthly income, and of course that's derived from the rental income from the home. A lot of our investors are looking to the future, and they're saying, well, I need to plant seeds in some income properties so I can really help my retirement, and that's a great strategy. Some people are saying, I need to buy a house today because my daughter or my son or my daughters and sons are going to be going to college, and I need to build up that education fund because I'm concerned that my RESP isn't going to do it. So we see lots of Canadians right now utilizing real estate as a form of savings for their children's education. A lot of people, of course, as they build their wealth through real estate, of course, you can pass that on to your heirs, and real estate has really formed a big part of individuals' estates when they pass on and they leave their assets to the heirs of their estate. Real estate's really formed a big part of that, and so this really magnifies that and really allows them to participate, maybe on a bit bigger scale, in getting some more real estate to pass on to the heirs. And then, of course, ultimately, we're looking for financial freedom, and what we're looking to do is we're looking to obviously get the passive income turned into, active income turned into passive income. There's a few different types of real estate investment opportunities you can participate in. First and foremost, right now, there's a great opportunity in single-family residences or single-family homes. And right now, with the undervalued real estate market in the U.S., when we can buy houses for $100,000, $120,000, $140,000, it's a great opportunity to participate in single-family homes. Condominiums, townhomes as well form great investment properties for our investors, and there's some just great opportunities that we see coming up in the near future for condominiums and townhomes and multiple dwelling units. And in the near future, we're also going to have multifamily properties that are available to our JV Club members where they can actually participate in large multifamily projects. So lots of different things you can invest in and diversify your portfolio in the asset class of real estate. Talk a little bit about Arizona and why Arizona. As us as Canadians, we look at Arizona and go, oh, it's a fantastic place. It's got great weather. It's got great golf, great entertainment, and a good place to visit with the family and maybe the golf buddies too, and head down there and play some golf. But really, from our perspective, it's all of those things. It's a great snowbird destination, but really, the fundamentals are so strong. It's got a very strong business climate. The average age is just over 35 years old, so it's a young, educated workforce that's there. And we like that as real estate investors because what it means is it means that we have a young, vibrant community, and it means that people are spending money. It means that they need housing, whether it be ownership or rental. They're buying cars, TVs, stereos. They're going out and they're shopping. They're spending money on entertainment and food and things like that. So it's a vibrant place. And as an investor, you want to be in a place where there's a growing population, growing workforce, and if it can be in that younger age bracket, it means that it's very sustainable. And Arizona's had that for a number of years. But again, us as Canadians, we go, geez, it's a great place. I can go see some great hockey. I can see some football, baseball, basketball. It's good shopping. So it's really good for the whole family all the way around. What we're talking about here in the U.S. is we're talking about participating in the undervalued real estate market that's really been pulled from the subprime crisis, the financial crisis, the depression that's going on in that marketplace. Some of the best time to buy real estate is when it's low. And right now in the U.S., it's undervalued extremely. It's a way overcorrected market. Now, it's not just Arizona where it's an undervalued market. Florida, for instance, has definitely an undervalued market, very similar to Arizona. However, based on our research and our analysis, for Canadians to invest in Florida, we're not at the same advantage as if we invest in Arizona. And the reason why I say that is this. As a Canadian, to buy an investment property in Florida in your personal name, you would pay more tax, pretty much double the property tax that you would pay, that a local Florida resident would pay. What that means to an investor, it means that your return is eroded because your costs are more money. The other thing is when you look at your insurance cost is more money in Florida, and the reason why that is because of the hurricanes and tornadoes, because there's so much money that the insurance companies have to spend to rebuild these houses that are hit from those disasters. It means that your insurance premium to insure your investment property is more money. So what does that mean for a Canadian? Again, it means that your return is eroded. And so for us, it didn't pass the grade, and it failed for us. Nevada, we feel, Nevada's a strong market. It's got some strong fundamentals. It was the worst hit state of all the states from the subprime mortgage. And the reason why that is this: it was one of the states that had the most per capita consumed subprime mortgage debt. It also had the highest peak to trough. So what I mean by that is if the run-up of the houses went up to $300,000 and now that house is $120,000, it had the highest peak to trough drop for the median price of a single-family home in the U.S. So we looked at Nevada. It's got low corporate tax, well, no corporate tax, no personal tax, and it's got low state tax. There's lots of things that favor it. The reason why it didn't work for us today is because it's not as fundamentally diverse as Arizona. And what I mean by that is I mean that it didn't have the employment makeup diversification. When we're looking at investing into a market, we need to see lots of different types of employers. And the reason why that's important is because if it was reliant upon 1, 2, or 3 employers, major employers, such as Nevada with gaming, hospitality, tourism, they also have distribution there. But if one of those 4 fell, it would have a detrimental impact on the population, and it could have a detrimental impact on the desirability of people to get into our rental properties. So even though we think it's a good market, it came second to Arizona because it wasn't as fundamentally and economically diverse. California, for us, we modeled it, and it failed on a number of fronts. The first thing is the property values are just too high. The ROI doesn't work for investors. The next thing is it's a judicial state, meaning it takes longer for the properties to go through the foreclosure system. It just takes too long to get them done. The third thing is we have some major concerns with regards to the state deficit. This deficit is so high that we feel that that's going to get pushed on to the back of property owners, and of course if you're an investor, you're a property owner, and we fear that it could have an impact on the increase of your property taxes to help offset the state deficit. So we didn't like that. But first and foremost, I got to tell you it didn't work because the numbers didn't work because the property values are still too high there. Arizona for us was the chosen market to participate in for a number of reasons. One is Arizona Investar is very familiar with Arizona. We've been there since 1984. We've been in and out of those boom-bust markets, so we understand it very well. We understand the players in the market. We know who to participate with for property management, renovations, insurance, things like that, and who not to participate with. The other thing is it's got so many things going for it. The Phoenix marketplace itself is extremely overcorrected. What I mean by that is where prices are for the median price of a single-family home in relation to where they should be. It's overcorrected, and I have a slide in a couple minutes I'm going to show you that really speaks to that. Homes are well below replacement cost. You know, typically a used house is about 85% the price of a new house. So as a new house price increases, as an investor, we like that because it means that our used house increased as well, because there's a parallel between the price of a new house to the price of a used house. The other thing is the market has bottomed for single-family homes under $200,000, and that's proven. The knife, when it drops, when the housing values are dropping, we call it when the knife is dropping, where do you step into the market? We like to step in near bottom. It's tough to say, oh, bottom is going to be in April of 2009, I'm going to step in then. It's tough to gauge that, but what you want to do is you want to be in the bottom end of that curve and then coming out of that curve, which is what we're doing now. So it's actually bottomed under $200,000. Now, a house that's $500,000, $1 million, $2 million, $3 million, that's not the case. We feel that there's still a little bit of room to drop there, and that's an oversupplied market over $500,000, but definitely an opportunity at under $200,000, and that's where investors like to participate. That's where you're going to be having a property that the average person can afford to rent and that's also where you're going to see the best ROI, so that's return on investment on your money, and we're going to see some nice appreciation in that market. And the other thing I'll tell you is that when you're coming out of a recession, the first market to pull out of it is the starter or one-time step-out homes. So the lower price homes are the first ones to recover before the upper end starts to go off. We have a strong Canadian dollar. It's a great time to invest your money in the U.S. Money's at par. You know, in the past when we were doing deals in the U.S., I always had to pay a difference. I had an 80-cent Canadian dollar or an 85-cent Canadian dollar. Now I'm battling with parity. It's almost at par. So it's a great thing for us to be down there right now. Low interest rates in Canada. Like if you were to pull a HELOC on your homes or a second mortgage, things like that, you have very low interest rates. So you can pull money out of your house to invest in real estate, very, very low rates. And I know that there's some pressure from the Fed to get that increase, and I see some media there last week about that as well. So it's a great time to step in now and utilize Canadian bank financing out of your own existing assets to invest in real estate in the U.S. Also, you can get good rates fairly good rates in the U.S. as well. We have a strong and growing rental market in Phoenix, which is extremely important as an investor. We want to make sure there's demand for your product, which there is. Banks are not extending credit easily to owners in the Arizona real estate market. If you have good credit, a 700 plus beacon score, and good job stability, and 3 times cash flow to mortgage payments, there's a chance you can get a mortgage, but it's definitely not like it used to be. So as an investor, I like that because it's tougher for homeowners to get into that market. It means that they're going to be needing our rental properties. Arizona is also a landlord state, and it's also a pro-business state. So a landlord state means the state laws favor the landlord. What I mean by that is if, say, that you have a tenant in your property that decided they're not going to pay you rent anymore, you probably won't want them in your home. It takes about 45 days to get them out. Let's look at California. California is a tenant state. What that means is it means that the laws favor the tenant. As an investor, you have a tenant that's not paying you rent. It takes you about 6 months to get them out of your property, and that's the second worst state in all the U.S., only next to New York. And so it's Arizona's a landlord state. We like that. It's been that way for years. It's also a pro-business state, meaning that they favor business. They favor businesses moving into the state, and they offer some state tax incentives. There's lots of land there. It's affordable. Businesses can lease space relatively cheap, and housing is affordable for employees, and has some great lifestyle. Arizona is also a lien theory state, and what that means is it means that the houses can move through the foreclosure process a lot quicker than, say, if it was a judicial state. And a lot of provinces in Canada are judicial provinces. Some of the states are judicial states. So if it's a lien theory state, it means that it doesn't have to go through the courts to get it foreclosed on. The bank just hires a trustee, and the trustee commences the foreclosure action, and you can usually have the complete foreclosure done in about 4 months. Versus, say, in a judicial state like California or Florida, it could take up to 6 months to a year to get the foreclosure process done. So it means that the foreclosures can go through the process a lot quicker. Shadow inventory in Phoenix is dissipating. What I mean by that is I mean that the amount of foreclosures coming through the pipe that have not actually been foreclosed on yet, we watch that very, very closely because that tells us how much inventory is coming through the pipe, and of course that has an impact on future values. It's dissipating. It's down 64% from 2009. And so the inventory is dissipating, and it's a finite number. So the amount of foreclosures that's going to happen in the Arizona market, it's not going to go on forever. This opportunity isn't going to last forever. And so there's a finite number of houses that's in foreclosure right now. We track that, and it's reducing down drastically. It's a non-deficiency state, so somebody who's getting foreclosed on by the bank, they only lose their house and they'll get their credit report marked up a bit. The bank cannot go after their other properties, or they can't go after their car, or anything like that. So it's a non-deficiency state, or non-recourse loans is also called that as well. Economic indicators for Arizona, they indicate a buy market for investment, both for Americans and Canadians. And so for us, it's a green market. It's a go market for us. The economic indicators are very, very, very strong. Here's an interesting slide. This is actually residences owned by Canadians. And so if you look at the blue dots, and this is the Valley of Phoenix that you see here, and this is north, south, east, and west. And so this is where Canadians are. So let's take a look at this. We see a lot of Canadians over in the Surprise area, in that northwest part of Peoria. We see lots of Canadians over there. We see lots of Canadians up in Scottsdale. A lot of Canadians for second homes. They like Scottsdale. So Scottsdale gets lots of Canadian ownership, as well as the East Valley, where we're very active with our investors. That would be the East Valley. So that would be Mesa, going into Apache Junction, and down in the Chandler, Gilbert area, and also over here in Queen Creek there's lots of Canadians as well. So very interesting graph here to see the blue dots represent where the Canadians are. And you might wonder, how did they get that data? How that data was gathered is through addresses. So it's properties where the mail goes to a Canadian address. And that'd be like, where does the tax notice go? It goes to a Canadian address. So that's how that data is pulled. So it means a Canadian owns a property there, and they got their mail going to Canada for their U.S. property. So pretty interesting graph. Let's take a quick look at the market overview here for Phoenix. Some very interesting things going on here. This is an interesting slide, and I don't mean to inundate you with lots of technical data. I don't even like the word technical. It sounds too technical, and I like to sorry about the phone there, everybody. I like to take things and kind of break them down so they're not so technical. And so I'm just going to walk you through this, what this means to us here. If we take a look at the active listings right now for lender-owned properties, that would be foreclosures that are actually on the MLS. So let's take a look at this. So right now, today, well, actually at 4/20, so that would be yesterday. So very current data. We have 1,444 active REOs, real estate owned by the bank, foreclosures in the marketplace. And that is down drastically from where it was last year. So if we look at last year, on April 20th, there was just under 5,700 listings that were REOs. Today, 1,444. That's important for investors to see because it shows you have declining foreclosure market. So the listings that are bank owned, they're declining. That's important for us to see that. It means that that market's on the recovery mend. If we look at the sales per month, 1,773 sales on the month. If we look at the month before, 1723. Look at the last quarter, 1837. And if we look at last year, 4463. So month over month, we're up just a little bit month over month, but still it's a strong market that we see here. Days on market for sales, it's 54 days on average for the market. It used to be last year 90 days on the market. So you can see 54 days on the market isn't long, so it's turning into a seller's market for houses priced under $200,000. So very important note there. The other thing is months of supply. How much supply is sitting in the marketplace? 0.8 months is in the marketplace versus, say, if we looked last year, 1.2 months. So we see a declining inventory there, and things are really starting to happen. The active annual sales per square foot, $62.63, and the active listings is $93.93. So some really good stats here that we see here that's happening in the Arizona marketplace, and really speaks to now's a good time to step into that market. If we look at the sales per month in Greater Phoenix, and again, I don't mean to inundate you with technical data, but it's important that we go through this so that you're educated before you make your investment. It's really important that you understand what's going on in that market. And that's part of Arizona Investar's whole program before and even after your purchase or your second purchase or third. It's something we do on a regular basis, is we provide market statistics as far as where our investors are placing capital. So if we look at the sales, if we look at the green line, this whole green line here represents the year 2010. So you can see exactly all the sales that took place in 2010. And these are MLS statistics. The blue line represents 2011. So you can see the sales that took place in 2011 on a month-over-month basis. And you can see the red line represents where we are here in 2012. So if you see where we are in March of 2012, kind of exactly where we were in 2010, which had a strong sales process. So you can see that in the month of March there were 7,258 transactions on the MLS. So those are actual sales that took place in the MLS. So vibrant, strong market. If we take a look at this line here, this is the median sales price of a home over the last 12 months. So you can see a year ago it was about $118,000. Today, $139,000. So if you look at kind of what's happening here, you see a trend, don't you? Prices are increasing, and it's still an extremely undervalued market. So it just has to keep going up as we get closer to replacement cost. Sales per month. You can see this is the sales per month over the last 12 months, very similar to the previous slide we looked at. And here's what's pending out there in the marketplace. So it means that there's a transaction that's pending, typically subject to financing, maybe a home inspection from a buyer's perspective. So here's pending transactions on the MLS. So you can see there's lots of pent-up sales that's still coming through the pipe, and it's going to put upward pressure on prices. As real estate investors, we want to buy low, and we want to ride that market up. And I'm not saying sell high. I'm saying maybe refinance, pull out some money, tax-free, and maybe buy another property. And that's the key to having multiple properties and creating true wealth in real estate, is having that multiple property platform work for you. It's one of the ways you can do it. Let's take a quick look at the Arizona MLS, so that's ARMLS. Let's take a look at the closed rental contracts by month. And if you look here, if we look at the last part of last year, you can see that this blue line represents the closed rental contracts here in 2011. So you can see the blue lines have been strong all the way through pretty much 2011. And where are they here in 2012? Well, let's take a look at this orange colored line here. Well, it's even exceeding where it was in 2011. So again, these people getting foreclosed on, they need good quality homes. A lot of them are good quality people. They just got bamboozled into bad mortgages. And so they're getting into the rental market, and they can see just huge demand for our rental homes. So that's good for investors when there's that much demand for our property. So that's a big thing. So that's a great graph to see. Let's take a look at this one here. This is it's kind of our market distress graph. And kind of shows us what's happening on the listing side for listings on the MLS, and what's happening for actual sales. And can we draw some parallels here and see what's happening? And I think we sure can. If we take a look at this, the average active listing that's there right now is $208 per square foot. But the actual sale value is $110 per square foot. Pretty interesting, eh? So it's listed for $208 a square foot, and it's selling for $110 a square foot. That's pretty interesting. If we take a look at this signal here, if we look at the market, 7% of the listings are lender-owned properties. So that's 7% are lender-owned properties. However, 21% of the sales are lender-owned, which is also known as REO. So those are foreclosures that have taken place. So 7% of the listings, 21% of the sales. So pretty interesting stat there. Look at this here. Look at the sales for traditional transactions. So if Mike and Sally were to sell their houses to Kim and Jim, they would typically be trading at $110 a square foot on the MLS. So that's a traditional transaction. But if you look at a pre-foreclosure, so a house going through foreclosure, $73 a square foot. In a foreclosure, a lender-owned, $75 a square foot. So would you rather pay between $73 and $75 a square foot for your property, or would you rather pay $110? So you can really see there's an arbitrage here, can't you? So this is a traditional sale. People just trying to sell their house. They're not under any stress, and they're not getting foreclosed on. They just want to sell their house, $110 a square foot. Or you can buy this exact same property, lender-owned or going through a foreclosure process, $73 to $75 per square foot. So that's a big difference in the price of the transactions from a traditional sale to a foreclosure. Let's take a look at the Housing Affordability Index. You can see what's happening is from an affordability standpoint. And the reason why that's important to an investor is because we want to participate in a market where the average people can afford to rent our properties. And if you look all across the U.S., you can see Phoenix is ranked 3rd in all of the U.S. for housing affordability. And this is based on the stat from the last quarter of 2011. So as investors, we like that because most people can afford our property. So that's a good thing. How long until the inventory of single-family homes and distressed property returns to normal? That's the big question. A lot of people say, well, how long is it going to last? Where are we in the market? Are we at bottom? How long do you think, how much more time before I have to step in? And here's our answer to that question. So we run a 12-month running average based on the amount of supply coming through the pipe of foreclosures and the amount of demand for homeowners and investors. And so we've got the 3-month average here is the blue line, the 12-month average is the red line, and it's coming to an end here, everybody. We're coming close to being wrapped up from the foreclosure market. We probably got about 8 months left in our estimation to buy single-family homes at the prices that we're paying for them right now. There'll always be an opportunity in real estate, but right now is a special opportunity because you're way overcorrected. It's way undervalued. We probably got about 8 months to buy at or near the level that we're buying at right now. However, there is definitely upward pressure on prices. So when should you step in? Today. That's what it's telling you. And that's not a sales pitch. If you want to wait 6 months to step in, hey, that's fine. You can do that. It just means you're going to pay a little more money for your property. I'm going to be able to show you that with this slide right here. This slide tells us what has been the average price of a single-family home since 1989 to today. Where are we at? And so the average price of a single-family home usually chugs along at about 4 to 5% annual appreciation per year. So good return. If you just bought a house, sat on it, you're going to make 4 to 5% per year in your money. Better than what the bank's paying and pretty much better than what the stock market provides. So between 4 and 5% just by sitting on the house without buying it at a low. You're just buying a house, riding it out. That's a normal real estate market. That's the average in North America for the last 30 years. So that's a pretty good historical trend, and we can use that to our investing advantage when we look at those trends. But what happened here in 2003 with the creation of the subprime mortgage where pretty much everybody could get a mortgage. You could have bad credit, no down payment, no job, and you can get a mortgage. As crazy as that sounds, that's the reality of it. So can you imagine when anybody can get a mortgage? Well, can you imagine what that did to housing prices? Because it's supply and demand. Now everybody can get a house. Well, what happens is it puts pressure on your housing stock, right? So can you imagine all the listings on the MLS probably went down to next to nothing, which they did. And can you imagine builder inventory? You know, builders usually do, say, 500 houses a year, and all of a sudden they got demands for 5,000 orders for houses. Prices, they better raise their prices. Demand is outstripping supply, so that's exactly what happened. Prices just went through the roof. What happened here in 2007 is when these mortgages that were done in 2003 and 2004 started to reset. When somebody's payment went from $1,000 a month to $2,800 a month, guess what happened? They couldn't afford to make those payments anymore. So instead of mailing in checks to the bank, they mailed in the keys because they couldn't hang on. And the bank said, hey, if you're not making that monthly payment, like you knew that mortgage is going to reset. That's all part of the subprime mortgage. Your payment's going to increase. You knew that. Well, yeah, but I couldn't afford it. I thought I was going to be able to flip my house and make 50 grand. It didn't happen because what happened is when they all reset, and they started resetting by the thousands, now you get an oversupplied market, not enough demand, and subsequent downward spiral of prices. And this is just true principal fundamentals. With every up, there's a down, and with every down, there's an up. I'd rather buy on the down and ride it up, not buy up and then ride it down. It's just basic principles. When there's an up, there's a down. When there's an in, there's an out. It's just the way it works. And so with this up, of course, there's a down. But when you're looking down here, and now we are at bottom, great opportunity. So here's where we are today. Prices are at bottom, and you can see they hit bottom in April of 2009. Went up a little bit. Second wave of foreclosures, we came down a bit. Now we're getting through the rest of the foreclosures in the marketplace, and right now we're right in this space right here. So what's going to happen is over the next few years, we're going to see accelerated appreciation. Here's normal appreciation right here, which is great, but we're going to see accelerated appreciation as we pull up to what we call the normalized trend line, and then we should just have normal appreciation thereafter. Sure, there'll be cycles in the market, but time the cycles and play them. But if you buy here, you'll always be okay. Hang on to that house and never sell it, just refinance it and buy more properties. So this normalized trend line, this green line right here, what we call the normalized trend line, this is really where prices should be of properties for resale homes. And the reason why I say this is where they should be, and how do you know this? I know this because this is where replacement cost is up here. This is where the value of your property should be here. Replacement cost is here. So in a growing market, which Phoenix is one of the strongest growth markets in North America, in a growing market, you need new houses. So people need new houses. Do you think they're going to pay new home price for them? Absolutely they are. So what does that mean to the used market? It means it's got to pull up to get closer to the new home values. So this is the normalized trend line. This is where prices should be. We're going to see accelerated appreciation pulling up to the normalized trend line as the foreclosure inventory dissipates. Remember in the earlier slides I talked about the foreclosure market dissipating. We're going to see that happen. We're going to pull up to the normalized trend line. So very interesting graph here, and that kind of spells the market as far as where has it been, where is it today, where do we think it's going to go. This is an interesting statement. Arizona was one of the only 2 states to be in the top 5 growth states in terms of population, employment, and personal income every decade since World War II. So what does that tell us? It tells us that over years, Arizona has been a top performer in growth. And why is growth important? It's important because it means it's going to spur new construction. Why is that important to investors? It means that there's going to be upward pressure on appreciation on your houses because year over year in expanding markets, new home construction will increase in price year over year. Why real estate is an investment versus stock, bonds, and mutual funds? A ton of our investors are coming out of the stock, bond, and mutual fund market. Why? Because they're getting killed, and they've been getting killed for years, and they're tired of all the emotional swings of those markets. They know who's making money there, the stock promoter, the guys behind the scene, the guy who's selling the mutual funds. They're the ones who are making the money. The investor's not making the money. And for years, the government and Wall Street and the banks have been making money on the back of investors. That's how it works. That's their business model. They make money from average investors. Average investors don't make any money in those markets. Unless you're on the inside, then it's called insider trading, and it's illegal. So it just simply doesn't work. Years over years have told us those models don't work. We're trained in school to learn how to invest in stocks, bonds, mutual funds. Why? Because that's what the big banks want us to know is how to do that, and that's all they want us to know. The reality is real estate outperforms those markets 10 times. And you can see just from this graph, if you go back to since 2000, you can see the Dow's been up 6.7%, S&P down 12%, NASDAQ's down 30%, real estate's up 43%, including the boom-bust cycles. So the problem with real estate has always been investors could never get in. They couldn't, it was too difficult for them to go buy a property in Phoenix. How do I do that? That's why we exist, because we help people get into real estate investing, both in Canada and the U.S., and we pick the markets to be in. And so real estate's the market to, is the investment class that we see, hands down. Phoenix is a growth market. We've talked about that. And so here's a graph that really depicts that. So if you look back to 1925, you can see where was the population in 1925. You can see by the color index on the right-hand side of your screen where was that market. And you can see as we step through the years, you can see the different color codes, how Phoenix has expanded in population growth. And again, we like that as real estate investors because we like growth because it's upward pressure on our appreciation of our houses. The earlier you step in, the better off you are and the more you're going to enjoy of that. This slide also tells us where are the major employers. You know, earlier in the presentation I talked about it being very fundamentally diverse from an employment standpoint. There's many, many different employers that call Phoenix home. And if you look around and you see the black squares here, you see some big names. Honeywell, Motorola, U.S. Airways, Banner Health, huge employer there. Insight, Swift Transportation, huge company. Walmart's got a huge, huge base there. Wells Fargo. There's just Intel's in there. American Express is in there as well. You're not going to see them on the screen, but they're there. Very, very economically diverse. And also this slide also shows us some of these lighter color areas. This is where Arizona Investar is helping Canadians buy investment properties. And so we're buying in North Phoenix, Glendale, Avondale, Goodyear, Chandler, Mesa, Gilbert, a little bit out here in Queen Creek as well. And so you may go, well, why are you buying in those areas and why aren't you buying like right in the center of Phoenix? Why aren't you buying in Scottsdale? Why aren't you buying up here in Cave Creek? The reason why is because there's 1,500 homes under management, we've got a big, big rental database to draw our information from in our statistics, our analytic statistics. And to say, what are the strongest areas for rental demand? It's these areas right here. We also had a study done by a third-party economist, one of the preeminent economists in the Valley of Phoenix. And we said, do a study and model the last 3 economic downturns and tell us the areas that appreciated the most amount of money in the shortest period of time. And they gave us those statistics. And we broke it down into subsectors of each city. So this is the city of Phoenix. This is the city of Chandler, city of Mesa, city of Gilbert. And you'd go from one to the next without even really knowing you changed cities, other than maybe the sign on the side of the road that says, welcome to Mesa. We overlaid that data for the appreciation factors over top of our rental analysis. It actually told us not just which city to buy into, but which zip codes to buy into. So when we talk about our proprietary acquisition system for our investors, that's what I'm talking about. It's that level of data that's behind the scenes that really drives where we buy our properties and what properties to buy in those areas. So pretty interesting slide here. Just another slide here that shows some of the major Fortune 500 and 1,000 employers that's in the greater Phoenix marketplace. Lots of major employers there, very economically diverse. Where are people moving to and where are they getting jobs in Arizona? From 1999 to 2009, this is a pretty good stat. Just shows you that 74% of the people are getting their jobs in the Phoenix area. So that'd be in the Phoenix Mesa Valley, so in the Valley of Phoenix. Quality depends on more than just population increases. So we talk about population increases, we talk about job growth, extremely important. Other things that are important as well is to have an educated workforce. And Phoenix has that. It has a young educated workforce. Actually, the Arizona State University, which is one of the top universities in all of the U.S., is located right in the Phoenix Valley. Educated workforce. Competitive tax structure definitely has that from a tax structure for corporations and also personal tax as well. Also has a low sales tax, no franchise tax. So it's a very competitive tax structure. As business owners, we love that. And as investors, we love that as well. And as people residing there, they're going to be renting your properties, they like that as well because they can keep more money in their pocket, have more money to spend. Affordable energy, water, and land. Things are affordable there. It's not like California or New York where things are very, very expensive. We don't like those markets. We like it when things are affordable for for the people who are going to rent your properties. Transportation infrastructure in Phoenix is very strong. It's so strong, in fact, that they can actually build roads before subdivisions are built. And the 303 is a prime example of that, which is a major freeway that's actually built before actually even any subdivisions were there. Lots of water, lots of waste treatment there as well. Transportation infrastructure is strong. Strong national and global brands that call Phoenix home, and we talked about the importance of that. Let's take a little bit. Let's take a look at our property acquisition system. Arizona Investar has a system where we buy properties before they're made available to the public, and that's what we offer our investors. on a turnkey basis. So let's take a look at exactly how do we do that. I told you in the previous slide where are we buying. So we're buying specifically in the West Valley, in this area through here. In the southeast side, we're buying in these areas here. We're not buying in Scottsdale because why would I spend $400,000 on a house and get $1,800 a month in rent when I can spend $120,000 on a house and get $1,100 a month in rent? It makes much more sense. I can actually probably buy about 4 of those properties versus the price of one property over here. So it just makes more sense from a return on investment perspective. So our property acquisition process is we do this. Every day we look at all the properties going through foreclosure. And so say on an average day there would be 800 homes going through foreclosure. Today it's probably closer to 400 because of the reduced amount of foreclosures going through the pipe. But say that the list, on the master list, there was 800 homes on the master foreclosure list. And this is houses going to foreclosure tomorrow. Based on our analytics and our criteria and based on our past performance of our properties, we can nail that list down and say, okay, well, we can nail that down to 50 houses just based on geographic location. And then we nail it down because we only buy a minimum square footage, which is typically a minimum 1,600 square feet, 3-bedroom, 2-bath, 2-car front attached garage, usually 15 years and newer, and it also has the tile roof on it as well, no lead-based paint. And so we can nail that down to 20. And then when we actually run the properties, we do the home inspections, we do the title searches on the properties, we see what encumbrances are on the title that we need to pay off. And we do the actual home inspection, we can nail that down to 10 from our physical inspections. So based on 800 homes, we've actually bid on 10. And those are going to foreclosure the next day. Now, I'm not talking about foreclosure on the MLS. They're not even on the MLS yet. This is before they get to the MLS, and this is before the bank actually takes them back. So when a house is actually going through the foreclosure process, when the homeowner still owns it, the day of foreclosure is called a trustee sale. We're actually at the trustee sale, done all of our review, our analytics, and made sure that the houses meet the fundamentals that we require, and we actually bid on the houses at the trustee sale. We go to the trustee sale, cash in hand, and hopefully we get our target acquisition and take it down. This is an example of the bid sheet that we look at on a daily basis. This is just a quick snapshot. It's many pages long, and these are all the properties that we run through. And we have a full team down in Phoenix that runs the analytics on these properties to determine, of all the houses going to foreclosures, which ones are actually going to qualify for us. And these are the ones here in the yellow of that particular list that actually made it to the top of the foreclosure list. Our property screening process that we go through is the first thing is obviously we make sure that it's in the right area. We look at the title to make sure the title, it is actually a first mortgage that's being foreclosed on, not a second mortgage or a third mortgage. And then we look at, make sure it's primarily a single family home area. It's got to be a minimum 3 bedrooms, 2 bathrooms, double car garage. Close to major infrastructure and employment sources, close to schools and shopping, and areas with very low vacancy rates. The physical site inspections that we do in the compilation of area data, we look at sales comparable analysis to make sure that we understand what are houses selling for in the area that we're buying our properties. We look at the rental rate analysis. We look at the tax searches, liens, postponements. We also do a physical site inspection. Once we get inside the house, we do an analysis to say, what is this house going to take to get all the rent-ready work done? And so we go through and do an analysis on that. So we're looking at a house that needs $5,000 worth of work, $10,000, $15,000, $20,000, $30,000. It makes a big difference on how much we're going to pay for the property and ultimately how much our investors are going to pay. We don't want this. We don't want to have a property and then find out that after we bought it, somebody ripped off the air conditioner, which you see happen quite a bit often on the MLS because these little thieves are looking to get the copper out of these air conditioners. That's what they're after, is they're after the copper because it's easy for them to go down the road and sell to a copper buyer. So we don't want that, and that's kind of the things that happen when you buy a property blind off the MLS. All of our properties come refit, ready to roll, air conditioners well in place for our investors. Our renovations, once we take down a property, it goes through our renovation process. So the first thing is we establish what is the timeline for the work that's got to get done. We already know what work needs to be done. We establish the timeline, confirm the trades are in place and ready to go, make sure the trades all have their insurance and workers' compensation insurance. We make sure we get our contract signed, do the inspections through the course of the renovation, and then make sure it's completed in accordance to our quality control standards. So that's our renovation process that every house goes through. And then we get into property management, get a tenant in place. And that's with one of the strongest property management companies in the Valley. And we have a very stringent tenant screening process that we go through to qualify all of our tenants. We get about 120 rental inquiries per day. And I know up here in Canada we're saying, wow, that's a lot of inquiries. It is. But you've got to remember, in the Valley of Phoenix, there's about 4.5 million people. And lots of people are moving there, and they're looking to obtain great quality rentals. So we get about 120 inquiries per day. Property manager is dedicated to specific areas of the Valley. The Valley is 8,000 miles square, and there's lots of area to cover, so we have property managers that are dedicated to specific areas. We talked about Arizona being a landlord state, which is great. Average tenant stays 2.5 years. Below market rents pay off. We're about 95 to 98% of market rent, because when one of our properties comes available for our investors, we want it gone right away. And so by being just a hair under market value allows us to get that done. And we always said treat tenants well and they treat us well. So we're pretty hard on the screening process with our requirement for credit bureaus and criminal background checks, verification of income. We do the tenant screening check through Tenant Network, and we just make sure that we've got good tenants in our properties. Some differences to note, I think first and foremost, is financing for Canadians is available. It's a little bit tougher. It's a little bit higher interest rate than what you typically see here in Canada, but financing is available for Canadians in the U.S. Closing costs in the U.S., we use escrow agents, and typically your closing cost, if you didn't use financing, would be about 1% of your purchase price. If you used financing, because of the requirement for title insurance and homeowners policy, would be about 3% of your purchase price. Just be aware of that. We use title agencies and escrow companies down there, and it's different. Here in Canada, we typically use our lawyer to close a transaction, and what we do in the U.S. and specifically in Arizona is we use an escrow company and title company to close a transaction. And the properties will come with title insurance to make sure that when you buy it, it's your house. So if anybody comes back and says, hey, that was my house, it wasn't foreclosed on properly, you have insurance to protect your title on that. So that's title insurance. Ways to take title, there's many different ways to take title. And what we do is before you buy a property, you'll go through your foreign tax consultation. And through that consultation, the professional will determine, based on what your objectives are today and in the future to investing in U.S. real estate, whether it be in Phoenix or any other states, we make sure that we understand what exactly is it that you want to do to make sure that the tax structure that we designed for you is appropriate for what you want to do. In some cases, you may just have the house in your own personal names with as community property with rights of survivorship. That may be the way to do it. If you're saying, listen, I want to buy multiple properties, then maybe we're better to look at a limited liability partnership, so it'd be an LLP. Definitely not an LLC, which most Canadians are told when they go talk to a realtor in Phoenix. Major mistake. Don't do that. That way you're going to pay double tax. So based on what you want to do and based on your foreign tax consultation with your consultant with Arizona Investar, you will know how to take title for your property. Let's take a quick look at how the numbers work on these properties. Here's a property that we just acquired. It's just finishing going through its renovation stage. Actually, it finished on Thursday, so it'll be made available to the public on Monday. First of all, it's going to go to our existing investors because they always get priority treatment. They get to see existing investors always get to see property before it's made available to the public. So this particular asset, 1,600 square feet. It's a 4-bedroom, 2-bath home. Its peak price, $230,000. So that's what it sold for at the peak of the market. The replacement cost, $205,000. The normal market value, where should that be today? $174,335. What is our Investar price for this fully renovated, cash-flowing home? $99,950. If you decide to get U.S. financing on there, we could put financing on there that would be just under $65,000, and that would mean a down payment for you of just under $35,000. Great home, great property, cash flow from day one. Let's take a look at the actual income from this one. So we talk about cash flow. So that's your rent minus your expenses. Annual income from rent, $11,400. Annual expenses for your property taxes, property management, your insurance, a little bit of maintenance, $2,232. Your mortgage payment, if you did go the mortgage road on this one, it'd be just over $5,000 on the year for your mortgage payment. Net positive cash flow, about $4,164. 10-year positive cash flow, indexing, of course, your rental income and your expenses, just over $60,000 in income over 10 years. And remember, on this property, you only put $35,000 down. So those are the types of things that real estate can do for you. So positive cash flow gives you additional monthly income and annual income for you and your family. Original purchase price of $99,950. Projected appreciation going to $142,260 over 10 years. Obviously, in a growth market and an undervalued market right now, you're going to see appreciation. It's just a matter of how much. So in this case here, we estimated it based on normal appreciation, the way it's been for the last 30 years, $42,310 we anticipate you putting in your pocket for appreciation. Principal reduction, if you did put a mortgage on the property and the tenants, of course, are paying your rent, you're making your mortgage payment every month. We anticipate your principal getting reduced down because part of your payment every month would be reducing your principal. So over 10 years, we would anticipate your principal being reduced by just over $8,600, leaving your net mortgage amount at just over $56,000. Sorry about that there, just too quick with the mouse. So let's just do kind of a recap on this house as to what we would project happening here. Original purchase price $99,950. Your down payment was $34,982. Your net positive cash flow after 10 years $60,000. Your appreciation just over $42,000 for your home appreciation. Principal reduction, your principal mortgage is getting reduced every month as you're making your payment. Over 10 years, $8,610. Your total pre-tax gain of all these added up, $110,943. Over 10 years, you invested $34,982. 10-year return, 315%. Annual, 31%. This is why wise investors love real estate. And more people are getting in the game, and they're getting out of stocks, bonds, and mutual funds. And more people are taking control of money into their own hands and controlling their destiny. If you'd like us to design a plan for you, we have a program with one of our consultants on Arizona Investar, where we have a lot of investors that say, I just don't want to buy one property. I want to be investing heavily in real estate because I believe in it and I believe what it can do for the short term, the medium, and long term for myself and my family, and ultimately my heirs. I want to buy multiple properties. We design a program for you where you can actually start off with one or two properties, and we can show you that if you practice certain principles that we lay down, you can buy multiple properties over the course of the years, and we can kind of lay down exactly how that would work for you in your portfolio. How Canadians can obtain bank financing. There is loans that are available from banks to Canadian investors. Those are called foreign national loans. And typically what you need is you do need a fairly good credit score, about a 680 plus. Your down payment on your property, depending on your credit, is going to be anywhere from 35 to 50% down, and your interest rates are going to be anywhere from 4.81% to 7%. Again, it's all determined based on who you are, how much you're putting down, and what your credit score is. The term of the loans is anywhere from 3 to 7 years. Amortization goes anywhere from 15 to 30 years. So we do have that available for our people that are looking to use leverage and maybe buy multiple properties. Some non-traditional financing loans, if you typically wouldn't qualify for a loan, doesn't mean that you don't have an opportunity here. We have a couple private lenders in Arizona right now that are part of the Arizona Investar program, and for people that have a down payment, so say you have a 40% down payment and you're okay with a little bit of a higher interest rate, we can still get you money. And it's basically a no qualifying loan, and with 40% down, so it's called an asset loan, and 8.49% interest rate, and actually the numbers still work. Even at that high interest rate, when I look at that I said, geez, that's a high interest rate, but you know what, the numbers still work based on our cash flow and based on the projected appreciation that we've got here. We're talking about a 5-year term. Amortization is 30 years for that type of product. So how to buy an investment home. So a lot of people go, geez, I'm excited, I want to move on here and I want to get into an investment property. How do I do it? Well, here's exactly what you do. First of all, show up to our webinars, register for them, get our market stats, know the market as to what's happening, and that's part of this education process that we're going through today. Register with our client care division. So either email us or call us, and I'll give you those numbers in just a minute. Register with our client care division. Speak to them about, I'd like to get going, I'd like to learn about how to get on this turnkey system. So do that, and do that as soon as possible, because the market has bottomed and it's going to start to come up. Discuss your investment objectives. What is your plan? And if you don't have a plan, we'll help you design a plan. So we'll walk you through that process. And if you do require financing, or you'd like financing because you want to buy multiple properties, we go through and get you pre-approved before you're even allowed to take down your first property from us. Also, we highly recommend that you get the foreign tax consultation done before you take one of our properties down. We don't want you to buy one of our properties until you get the foreign tax consultation. I see many, many Canadians that are buying blind down there because maybe they didn't know that we had this turnkey system. They're paying retail, they're buying in the wrong markets, they're overbuying the market, and then they buy it and then they figure out, well, who am I going to use for my renovation contractor? I need a tenant now. Who can I get a tenant? So the realtor says, hey, I know a property management company. Well, of course he does, because he's getting a referral fee, but it's probably the wrong way to go. And then once they buy the property, they go to do their tax at the end of the year, and the accountant goes, well, why did you form an LLC? He goes, well, that's what my realtor told me to do. He goes, no, you're a Canadian. You don't do that, because now you got to pay double tax. And that's going to cost you a bunch of money to unwind your transaction. I'm telling you, don't do it. There's a turnkey system here. We've got wholesale properties, premium grade properties, property management, cash flow from day one, and you can make it happen. Once you go through those process, you can select a property with our property specialist. You'll enter into a contract, and then of course ultimately you close on the property, close escrow, just repeat the transaction. It's a pretty simple process you go through with us. We make it real easy for you. We're pros in the business. We've been doing this for a lot of years, and we have a whole system that's geared for Canadians. And I can get you a better property, better price than you could buy for off the MLS with our proven system. So that's how you get into an investment property. And what we've got today is for investors to step in today. We can't tell everybody how important it is to step in today because the market's at bottom. You're buying houses at 50% of replacement cost. For people to step in today, just to help you out to get a little bit of additional cash flow, here's an exclusive webinar deal for you. If you call right away, you're going to get your free property management for the first year. So here's a property we've got. It's fantastic property. Just came out of renovation. Purchase price of this house is $130,000. Fantastic two-story home. Peak price was $300,000. It's in one of our core markets in Phoenix we're buying into. Lots of capital is getting put into that market. 4 bedrooms, 3 baths, 2,361 square feet. Check this out. Price is $55 per square foot. Unbelievably low price. Just to replace that value of that house would be over $100 a square foot, plus the lot, plus the upgrades. Tenant in place, cash flow from day one, $1,025 a month, built in 2006. And so if you call our number, 1-855-456-3223, and talk to our client care division, say, listen, I listened to Travis on your cash flow webinar. I'm interested in that house. I want to get going. Talk to me about the property management for the year. I need to get that consultation done for foreign tax. I'm interested in financing. I want to buy multiple properties. Whatever it is, take advantage of the opportunity today. Seize this opportunity. This is one of the times when, 5, 10 years down the road, you're going to say, remember when you buy houses in Phoenix for like $55 a square foot? And people are going to go, no way. And you're going to go, you know what? I did it. I participated versus, geez, I wish I would have bought a house back then because now that same house is $300,000. And so this is a time when you can capture the market with a full turnkey system. Feel free to join us on any one of our Arizona tours. We put them on actually every week, but once a month, the whole team shows up, and our renovation contractor is there, property management is there, foreign tax. Usually I'm down there, and some of the executives with Arizona Investar, and you actually get to see the entire team, meet the team. Good education in the morning. A couple of our analysts come on board. Alan Langston comes in. He's the president and founder of the largest real estate investor association in North America. He's there. And you get to meet the team. And so it's good morning education, have a great lunch on the patio, and then we jump on a bus and see some fantastic properties and hear some good stories about the valley and where does the water come from and how long does it take for a cactus to grow an arm and all these types of things. So it's fantastic. Seminars and webinars coming up. Of course, we've got the property tours on April 28th coming up next week, May 25th and June 22nd. Live webinars. Take advantage of the webinars. They're good educational formats. And you can learn lots from these webinars. They're well put together, and our team puts a lot of time in putting those together. So feel free to do that. If you haven't signed up on our website for our deal of the week, do that today. And it's just in the bottom left-hand corner of our website. You can just go in there, enter in your name and email address, and you'll get some great information from us on a weekly basis. You'll see our deals of the week, and just stay up to speed with regards to Arizona Investar and what exactly it is that we're doing. Where we are right now is we're at the close of the webinar as far as the formal presentation goes. Typically what we would do is we would get into some questions and answer period at this time, and unfortunately I'm out of time and I have to respect everybody that's here. I see we got lots of questions that have come in, and we're going to email you the answer to those questions. And it looks like we've got about 20 questions that have come in here. So we'll email the answers to all those questions, but again, I got to be true to my word. I got to be on time here with this webinar and respect everybody's time that's here. But on behalf of myself and everybody at Arizona Investor, I thank you for taking time out of your day. And just my closing comment would be, this is a really great opportunity where we're at here today in our lives, and where we can invest. And if you take action today, action speaks for the rewards in the future with a well-planned, well-educated approach, and that's really what we're talking about here. And I know you've heard it said before, but live where you want to live. If you live in Calgary, you live in Vancouver, Toronto, Montreal, Winnipeg, Saskatoon, that's great. Live where you want to live, really invest where the numbers make sense, and that's what we provide is these opportunities that may be outside of your home city. So from all of us at Arizona Investar, Chad Butler, who's our IT manager, sets all this up for us, and Carrie Butler does Carrie Smith does a great job putting this together for us on the presentations, and does a great job for us. Thanks very much for taking your